systematic entry, you need to wait for a candle. Now, obviously, you could simply use a candle reversal narrative. So, for example, we've got that candle there, and obviously the systematic entry would be a buy candle there, or simply a sell candle that closes lower. That's it. That is it. So there's your buy opportunity, either at the end of the green candle or as you break the red candle there. That could be a systematic entry price. That's the price that we talked about before. Now, based on that target, the target price you'd be looking at would be this phase here. So you can see that it is better than 1-to-1. So that's okay. We could do that. Take a 2% risk for a 2% profit on that. And once it's settled down, we can then start looking at the fact of the level 2 rejections. Second thing we can look at that stage is value. The third thing we can look at is volumes. And we see that the buy side volume vanished. So you're obviously starting to think, have we got any upside at all on this? Is there any way we can move the needle on this? We can look at the sentiment at the cash open. When we look at the sentiment at the cash open, we're not led to a particular trade strategy, are we? Except for the buy trade. Does everybody agree with that? Does everybody agree with that? Everybody would be buying into this initial story, especially Scott, who is trying to learn and understand these cash opens. The only trade you'd be taking would be a buy trade. There would be no sell option at that stage. So on that basis, you should have made 2% return on your account on a percentage basis. Remember, that's on a percentage basis. If you're trading a single contract, you're still making an even money bet on whatever size you're taking. The value does diverge. You could have said to yourself, well, the value's still bullish. On that divergence, you could have taken a possible buy side pop here. And you're running about an even money short. That's about an even money short, isn't it? Well, on the basis that it's an even money short, the value still looks pretty good for a buy, because in terms of relative value, let's take this high, for example, here. In terms of relative value, we're way higher than where we should be. Or we're way higher than we are. So the relative value would have had the S&P way up here. So you would have taken a shot at that squeeze, so long as you don't get the breakout trade. And obviously what happens is that you get the squeeze, and then you get stopped out at break even. That's all that happens, guys. So you got your +1 on this first trade here. I'm talking about +1 being the risk reward. And on this trade here, you got a 0, didn't you? You got an actual 0 in that trade, whatever you got. It was a break-even scratch. So when the price drops back down, you're now looking at the day low. Are you going to buy a reversal of the day low, yes or no? Are you going to buy a reversal of the day low as soon as you get that structural reversal? Yes or no? Not a hope in hell. Look at the value, guys. The value is way below where the value was before. Look at the day low. Look at where the cash market opened, and look at where the blue line is now, guys. Look. The value is so much lower than it was before. There's no way I'm going to buy a reversal off the day lows. Not a chance. Well, if I'm not going to buy a reversal off the day low, what will I be doing? What will I be doing? If I'm not buying a reversal off the day low, what will I be doing? I'll be selling a halfback. I'll be selling a structural sell from a halfback. I'll be selling a structural sell from a what? I'll be selling a structural sell from a spring trade, if you like, or a Heisman sell from a spring trade, because that's when we get a Heisman sell from a spring trade if the value is too much. So when we know that, we start saying to ourselves, okay, well, there's the low, there's the high, and there's the halfback, which is exactly where that green candle finishes. The value is collapsing. So yes, I really like that structural sell candle right there, yes or no? Based on that structural sell, have I got a better than even money bet on that trade? Yes, I have. I've got a better than even money bet on that trade, haven't I? So there's my structural sell. I've got to be in it. And what happens? We get jammed at the bottom edge. So you're either taking your money at that stage. You can see obviously the value is still bullish. So I don't think I'd be taking my money. So because I'm not taking my money, what happens to my trade? I get a scratch. I get a scratch, or a +1 tick trade, right? A +1. I don't try and take zeros. I always try and take +1s on my trade. It's always that little bit of a thing, isn't it, that you see that your P&L looks as if it's all wins because there's a lot of +1s in there rather than zeros. It is what it is. The short-term value rallies, the short-term value drops. I'm thinking to myself, spring trade. So as a seller of limit orders, I'm selling into that. If you don't like selling limit orders, you're waiting for the first red candle reversal. Now, the first red candle reversal was it's right beside it. Now, that means that you're running a very, very small stop. So 4 ticks is a tight stop, right? 4 or 5 ticks is a tight stop on that. But obviously, your risk reward is now getting huge. In terms of a percentage return, your risk reward on that as a percentage is now enormous. 3.4 times your money. 3.4 times your money on that trade, sell side. And obviously it hits that, and again the value is dropping again. So I'm quite keen to leave that trade in to see as far as I could possibly get a drive lower. And obviously what happens is that we get a drive lower. Now, because we've sold the half back, where should the first profit take be? Swing low and prop stops, okay? So we go for the prop stops. The prop stops price is the 50 projection here. Okay, so that's the prop stops target. And then our full target for that move is this price here. Now remember, we don't have to take targets. If the value is still improving, we can just simply pull our price away and let it go, carry on going if you want. It's your choice. You've got time to make that decision. So we trade into the prop stops. You can see we start to see a value divergence creeping back in here. And obviously on that basis, you might say, you know what, I'm going to close out that little trade there. And I'm just happy to see where it goes next. Based on that sell, in terms of return on a percentage basis, that sell just did 4.8 times your money. 4.8 times your money. Quite nice, isn't it? Quite nice. The value collapses again, and you go, wait a second. We've had a breakthrough here, but is it a structural breakthrough? Questionable. If you did call it a structural breakthrough, then obviously you're going to be left with this idea that you should be drawing a box here. What's that box called? That box is going to be called sellers pending. What happened to it? It's vanished. Okay, we'll try it again. So we draw a box here. We call it sellers pending. And we're obviously going to be looking to sell into that, but with the value rising, we can't sell it. With the value falling, we can now look for a structural sell. So did anybody see where the structural sell was? There it was right there. There's your sell. Your target price is now established quite clearly at the prior low. And as we come away from that trade, you can see we never get stopped out. Never get stopped out. We get through the target price. The value is improving, so I don't want to close out my positions. And we trade to the full target price. Now, obviously, if you've closed out your position here, you've just now traded to the full target price. And in terms of return on account, we can now establish that that percentage return on account was now 5.2 times our money. 5.2 times our money, guys. Plus 5.2. Now, obviously, it started to balance out in here. And the value is basically busted. So in my world, I'd be now looking at that and saying, that's it, guys. Tidy off. Finish up for the day. We're coming into 1440. You've done your 10 minutes. You've done your 15 minutes of activity. And we've taken a +1. We've taken a scratch. We've taken a scratch. We've done a +1. We're in pretty good shape, right? We're in pretty good shape here. We've done another 0. And then we made the real money. We made a 4.8 times our money and a 5.2 times our money. 5, 9, 10, 11 times our risk. If we're risking 2%, we've finished our day with 22% return on our account. 10 minutes work, guys, 22% return on our account. Tell me that's not possible. Tell me that storyline is invisible to you. Tell me that that is all visible to you. Tell me what's difficult about that storyline. Systematic entries, so you're not having to find leans. Systematic entries, wholesale price levels, straight lines, springs, drawing in some areas, checking your value, and just trading. There's nothing actually difficult about it, is there? As we come into the bottom edge, we can see that there is a big value divergence creeping into this area now. So what can we now do, guys? What can we now do? We can now start looking for a guaranteed discount. So how do we find a guaranteed discount? Well, if you count this break here, you'd have used this low, and you would have used this high here. That would have given you your first guaranteed discount price to target. So if that's going to give you your first guaranteed discount price to target, would you be accepting that the first guaranteed discount price is this price here? We get a lower low, and we get another structure high, so we could have another second guaranteed discount price based on this structure here. And on that second guaranteed discount price, would you now have an idea that this is the guaranteed discount price here? Two guaranteed discount prices, but the second one is known before the first one hits. So we now have an area. We now have an area. Whichever one you take, you now have an area where you're going to be looking for that guaranteed discount price to buy into, yes or no? Okay, let's do the numbers. Come into the area, and you say to yourself, okay, I'm going to go for this. And you take a pop at some business here. And you get stopped out at -1. Okay, came in too early. Okay, I get it. Came in too early. You try it a second time on this lower low, and you come back in again here, and you get a 1-to-1. So what's the worst case scenario here, guys? Worst case scenario, you get a 1-to-1, and therefore you're taking a scratch, right? So you get a 0. And then you say, okay, it's still too early. Then you get another opportunity to come in here. And on this occasion, you can see that you get a reasonable upside pop back into this little change of behavior level. In terms of returns on your account, you could probably agree that the return on that account there is reasonably good. The return on that account, sorry, is reasonably good. And, you know, getting up into that area, you're probably making 2 times your money. Worst case scenario, 2 times your money. So let's just assume that you decide because you've taken a loss, you want to make sure you get some money, and you take 2 times your money. The price comes back down and the divergence is still in place. You now know that we've got a new swing low here, and we get another reversal here. Now, it goes to even money, so you either took a scratch trade, but if you didn't take a scratch trade, your stop below the bottom edge here would not have been triggered, so you never get triggered anyway. So whether you took a scratch trade or took a bigger stop with 1 tick, it doesn't make any difference to the numbers. If you took a scratch trade, you would have purchased back in again here. So you'd have been able to get into the trade, but you'd probably still use the same stop on the basis that the difference is only literally 1 tick different. There's your structure. There's your capper price. 3 times your money, 3.5 times your money, guys. The value's still good. You're back in the same area. And then we get this candle here. So, Sebastian, are you a buyer? Are you a buyer in that candle? Structural reversal, buy trade, yes or no? Not a chance, right? So what have we got to do? We got to get a high price, we got to get a low price, and we can start thinking about a buy at the halfback, a buy limit order at the halfback. Now, if you don't like buy limits, what you're going to do is you're going to wait for the reversal through, come back through the level, and then buy here. Is that good enough for a buy trade? Yeah, well, that's even money. But it's a better even money chance because you've now got two levels of liquidity above it. You've got a cascade of liquidity above that price. Secondly, the value is exploding north. So that looks like a very, very, very reasonable buy-side proposition on that green candle. Very reasonable price. You're getting offered a great price with a very nice, easy to see confirmation that that's the trade you should be on. What happened? Well, well, well. How do you like that? You couldn't make it up, could you? You couldn't make it up. So you bought in here. Stops are below the green candle, and you've just managed to accelerate the price for a return of 8 times your money. I'm not saying that's it. I'm not saying that's what you'd have taken out as profit, because obviously you'd have to do some calculations now about whether you want to take profits. But I don't see any reason. I don't see any reason why you'd have taken any profits earlier than that, because the value is suggesting we should actually be somewhere around about 37.50s, never mind 37.44s. So you're probably thinking to yourself, I don't want to take profits, but I'm starting to get a bit of a measured move here. So even if we'd taken the measured move based on this bracket here when the accumulation started, and we're coming up into those areas, we're starting to get into that measured move. We've already exploded past the measured move of the actual bracket itself. So really you want to make sure you take profits on the first rejection. So your actual profit take was probably on that candle reversal just there. It's a nice way to just not use a hard kind of fixed trailing stop, but use the price action, the volatility to stop out in that position. And what was your return on account then on that basis? The green candle there. The stop below the green candle. And the target price there. 7 times your money, guys. 7 times your money. Still pretty good, right? So now for that buy trade, you've done -1. You've taken your first loss. You've taken a scratch trade. You've taken a +2. You've taken a +3.5. And you've taken a +7. 11 points. 11 times your money again, guys. 11 times your money. That's a pretty good day, isn't it, already? That's a pretty good takeaway already from that phase. You can see from that point onwards, there was another opportunity to buy again here, and I don't intend to go through every single trade here, but there's another opportunity to buy this one for the squeeze higher. Value was diverging beautifully at that stage. So buying into that trade there would have given you another 4 or 5 times your money again there. And then what happens? You're finished at the top edge now, aren't you? You're absolutely done at the top edge. We're coming into this pending sellers level in the background as well. You're already aware of that area on the screens because you've seen that big change of behavior when it flipped over. And you're going to be thinking to yourself, there's going to be a sell coming in from this price. So you start looking at that price level simply by drawing a straight line across your charts. You've seen a toxic reversal already on that candle. So where's your first sell trade, guys? Would it be there? Absolutely. Did you get a scratch trade, worst case? Absolutely. Did you get another sell trade here? Absolutely. Did you get better than a scratch on this occasion? Absolutely. And what's happened since then? Well, you can see the value should be bearish, so there's no way you're going to close out that trade. You get a push through the level. What does that mean? That means that this becomes a pending seller's level. This becomes a pending seller's level here because we've had the push through. And when the price comes back up, we start looking at whether we've got value to sell into this. Now, I don't really like the short-term value to sell it at first, but it certainly improves on that candle there, allowing you to get short on that occasion, which ends up as a scratch trade. And so it's improving a lot there. You end up scratching out, but you know that if you get scratched out, you've got to go again anyway. So that's about an even money proposition there as well. So you're going to be happy to take that one, and that's the one that's just broken south. Look. Is that not so easy? It's unbelievable. Is that not so easy that you just get annoyed when you haven't taken these easy trades? How much value is in that, guys? It's enormous, isn't it? So when we think about that, we simply look at the and then we want to make sure we draw that red candle there. And then when we come down into the low prices here, the return on our account is now 14 times our money. 14 times our money, guys. What? Yeah, 14 times your money. I mean, guys, come on. That doesn't include this sell here. We'll just take a rough idea of where it went from and to, guys, so we'll get an idea. So that was 11 times your money as well. This is obviously assuming that you're trading as a percentage of account. And we're taking off we're taking off all the decimals, so we're not rounding up, we're rounding down on each of these trades. So there's an 11 times your money trade there. There's a 14 times your money trade there. There's 10, 11, 12% there. There's 10% there. 10, 20, 30, 40, 45% return on your account at that stage, guys. 45%. You've nearly made 50% on return on your account in the first half hour of trading. Using 2% risk, using value, and using a systematic entry process. Not shortchanging you in terms of where your trades are or where you could have, should have, would have, but simply taking every trade that certainly has the value to take as a trade. Taking every trade. Does that give you any thoughts about the things that you're missing? Does that give you any ideas that you should be doing a lot better than you are? Does it show you where you should be trading? This is the whole point of education, isn't it? It's about showing you what you should be doing. And then comparing it to what you are doing and saying, what's the gap between the two? Where am I right now against where that picture is? What am I missing? What am I not getting? What storyline am I not seeing? From that, I can make a better, more constructive decision about whether to trade or whether not to trade in these areas, right? It's not that difficult. You see what's happened since then. The value is almost fair. There's a couple of tradable opportunities in terms of value. The one that stands out to me would have been this sell trade here. You can see the value is dropping back out. There's another one at the bottom edge here that looks like a very nice buy trade. With the value dropping, I'd have been very inclined to be selling that high, and I definitely would be selling that high, so that should also be in your book. I'd be very definitely selling that high, because that should also be in your book. And I would definitely be buying this low, because that should also be in your book. Would you agree with all of those trades in terms of bigger structures? I'd be selling into this. And I'm not picking out individual trades, guys. I'm just saying you would be working that structural sell in those areas and those structural buys in those areas as well. You can't disagree with them because they're all visibly, massively easy to spot in terms of value. Now, some of you might argue, well, why did you not buy when the price broke south here? Because the value line was making a new lower low. So I can't buy when it's making a new lower low. I've got no short-term value to work with. None. So I need to use that narrative to understand that short-term value against me means I'm not going to be doing any trades, etc. Simple. What is common about all these trades, guys? They all have a level beforehand. They all have a reason to gain some liquidity beforehand, aren't they? They all have a storyline in the background beforehand. Look, how many red lines are on that? There's more red lines than there are arrows because we're working structures, we're working levels, because structures equal volume. Volume equals liquidity. Liquidity equals what I need to make a decision. None of these trades are difficult. None of them. Do you agree with that? So you should have been making about 50% return on your account today on a 2%, on a 2%. That's not on a 2% basis, guys, because that's 50% return on your account based on a 1% risk. So if you're using a 2% risk, that's doubled your account size. If you're using 2% risk, that's double your account size. Doubling your account in one day, guys, simply by trading good stuff, nice easy stops, systematic entries. And there you go, guys, there you go. Taking the good stuff. Benchmarking, isn't it? It's all about benchmarking what a good trade looks like.